On September 17th, the Federal Reserve finally cut interest rates. Many people's initial reaction was, "Great! The market is finally going to revive." But I have to tell you, don't get too excited. This rate cut may not be a rescue, but the beginning of a crisis. Isn't that contradictory? On the one hand, it's a huge benefit, and on the other, it introduces new risks. Which is the truth? That's what we're going to discuss today. First, let's look at the data. Interest rates were cut by 25 basis points, bringing them into a range of 4.00% to 4.25%. This may not sound like much, but it's the first rate cut since last December and the first of the year. The vote was even more intriguing, 11-1, nearly unanimous approval. The lone dissenting vote wasn't against cutting the rate, but rather argued that the cut was too small and demanded a 50 basis points cut. Consider what this means. It means that the Fed is more concerned about the economy than it seems. This raises the question, why act now? For much of the first half of this year, the Fed held back, claiming that inflation wasn't over yet and refusing to act. However, recent data refute this assertion. The unemployment rate rose to 4.3% in August, significantly higher than last year's low of 3.4%. This increase was driven by millions of unemployed Americans. What about inflation? Although it has fallen significantly, the core PCE price index remains above target at 2.9%. Imagine your kettle is boiling. The flames have been turned down, yet the lid keeps popping. If you leave it alone, it might explode. If you suddenly throw cold water on it, the lid might crack. This is the Fed's predicament. They chose a compromise, cutting interest rates by only 25 basis points. Powell called it a risk management cut. In layman's terms, they had to cut, but they couldn't cut too much. The Fed is now walking a tightrope in a storm, recession on one side and resurgent inflation on the other. Friends, I have a question for you. If you were Powell, would you dare cut more, or would you take it one step at a time? When it comes to market reactions, we have to start with gold. It is the canary of the market with the sharpest nose. Before the news broke, gold prices had already surged to $3,702 per ounce and reached an intraday high of $3,727. After the news broke, however, prices closed at $3,658. Is this a peak? Actually, no. It's a classic case of buying the expectation, selling the reality. It's like buying concert tickets in advance, only to find scalpers selling them at a lower price when the show starts. The long-term logic remains unchanged. A weaker dollar makes gold more attractive. Falling real interest rates make holding gold less expensive, and global central banks have been buying gold for 10 consecutive months. This isn't a joke, but a strategic move. J.P. Morgan Chase predicts that the price of gold could reach $3,800 by the end of the year, while Goldman Sachs is even bolder, predicting $4,000 or $4,500 by 2026. So, my friends, if you own a gold ETF, will you hold on to it or lock in your profits? Now, let's talk about the stock market. Upon hearing about interest rate cuts, many people assume that everything will rise to glory. Wrong. This time, it's a diverging market. Who are the winners? Real estate and consumer spending. Lower interest rates make mortgages and car loans cheaper, so people are more eager to buy homes and cars. Tech stocks also benefit from looser liquidity and higher valuations. However, banks are struggling as their net interest margins shrink and their profit margins plummet. The stock market isn't experiencing a broad rally. Rather, it's a diverging market. If you choose the wrong sector, others might profit while you lose. So, let me ask you, if you had to choose between tech and real estate stocks, which would you choose? The logic behind commodities is even simpler. A weak dollar naturally drives up the prices of commodities such as oil, copper, and aluminum. Coupled with expectations of an economic recovery, prices of industrial metals and agricultural products could rise. This represents a boon to the economies of exporters like Australia and Chile. The U.S. Treasury market is also struggling. Declining yields on newly issued bonds lead to an immediate appreciation in the value of existing bonds, enabling investors holding older bonds to realize capital gains. In times of turmoil, U.S. Treasuries remain a safe haven for conservative investors. Of course, the impact extends beyond the U.S. A weak dollar means that capital will seek new destinations and emerging markets will benefit the most. Stock and bond markets in India, Brazil, and Southeast Asia will likely see a surge of capital. A depreciating dollar also means less pressure from external debt, which makes it easier for companies to raise capital and enable local industries to upgrade. But what about Europe and Japan? They won't sit idly by. To prevent rapid currency appreciation from negatively impacting exports, they will likely implement easing policies as well. This could lead to a recovery in European manufacturing and Japanese auto electronics and tourism. If pent-up travel demand were released, tourism and aviation industries could experience a resurgence. History offers a stark lesson. During the 2008 financial crisis, for example, the Federal Reserve aggressively cut interest rates, which sent Wall Street into chaos. Do you know who had the last laugh? Those who held on to gold. Gold quietly emerged from its decade-long bull market. Then, in 2019, the Fed resumed easing, prompting criticism that it was a desperate attempt to find a cure. The result? Tech stocks doubled in a single year. Anyone who dared to invest reaped the rewards. Friends, let me ask you, given the same circumstances as in 2008, would you buy gold without hesitation or invest heavily in tech stocks? As you can see, the Fed's current situation is truly like walking a tightrope in a storm. One strong gust of wind could cause someone to fall. Could the U.S. stock market cause a false boom? Could gold become the last safe haven? Or will rising commodities prices push emerging markets into a new bubble? No one can answer these questions with 100% certainty, but investors must keep an eye on these risks. So, what should ordinary investors do? The answer is simple. 3 simple steps. First, don't be blinded by short-term fluctuations. Don't be surprised when it rises one day and falls the next. Second, diversify your portfolio. Keep some gold, U.S. stocks, bonds, and commodities in your portfolio. Third, understand the long-term trends: technology, new energy, high-end manufacturing, and consumer upgrades. Those industries with global competitiveness are the ones you should bet on. In short, the interest rate cut on September 17th was more than just a minor adjustment. It marked a turning point in global financial history. The dollar weakened, gold prices surged, stock markets diverged, commodities recovered, and capital flowed into emerging markets. A new transfer of wealth has quietly begun. Those who discern trends and exercise patience always win. Finally, I would like to ask everyone, who do you think will become the wealthiest from this rate cut? Gold investors, tech stockholders, or those who invested in commodities beforehand? Let's discuss in the comments.